Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, a bombshell jobs revision rocks markets, erasing nearly 1 million jobs. With today's critical NFP report looming, will this trigger a crisis of confidence at the bell or ignite a rally on accelerated rate cut bets? Second, alert. Jobs data revision masks a deeper crisis. The jobless expansion arrives, challenging the Fed's power. The US just wiped nearly 1 million jobs from its books, and today's report is forecast to be disastrous. Is this the start of a new jobless expansion driven by AI? And if so, is the Fed now powerless to stop it? Finally, Paramount vs Netflix. The battle for Warner Brothers goes nuclear as a rival's bid is declared worthless. Paramount launches a stunning public attack in the war for Hollywood's crown jewels, backed by a tech billionaire's $40 billion bet. What happens at the open when this massive cash offer clashes with a board's poison pill defense? A deceptive calm on the surface, but a violent rotation underneath. While the headline numbers suggest a quiet Friday, institutional capital is aggressively dumping technology and fleeing into defense and energy. The era of easy growth is being challenged by a new fiscal reality, and the market is scrambling to adjust. The divergence across the major averages is stark. The Dow Jones Industrial Average rallied nearly 270 points, fueled by old economy cyclicals and defense contractors, while the Nasdaq Composite slipped nearly 0.5% as profit-taking hit semiconductor heavyweights. The S&P 500 finished essentially flat at 6,928, caught in the crossfire between a defensive rotation and tech weakness. The catalyst for this churning action is the December Nonfarm Payrolls report released this morning. The economy added 66,000 jobs, a figure that lands squarely in what strategists call the Goldilocks zone. It is not robust enough to force the Federal Reserve to tighten, yet not weak enough to trigger immediate recession panic. However, market experts point out that this number effectively kills the probability of a rate cut at the January 27th meeting. Futures markets are now pricing in an 88% chance that the Fed holds rates steady, though the probability for a March cut has risen to roughly 45%. This delay in monetary easing is forcing a rapid repricing of risk assets. The devil is in the details of this labour data. While healthcare and hospitality sectors continue to hire, the ADP report indicates that professional and business services shed 29,000 jobs. This is a critical red flag for the software sector. When corporations stop hiring consultants and white-collar staff, they inevitably cut IT capital expenditure next. Analysts warn that this creates a difficult setup for enterprise software companies trading at high valuations. If business spending contracts, the revenue growth justifying those 50 times sales multiples evaporates. This explains why capital is flowing out of high-duration growth stocks that depend on future rate cuts and into sectors with immediate fiscal support. Consequently, we are witnessing a massive capital rotation into the defense sector. Following President Trump's announcement of a proposed $1.5 trillion defense budget, a 50% increase capital flooded into prime contractors. Lockheed Martin surged 4% and General Dynamics gained nearly 2% as the market recognizes that government spending is decoupling from the broader economic cycle. This sector, often tracked by ETFs like ITA, is benefiting from a multi-year fiscal commitment that disregards interest rate headwinds. In technology, the selling wasn't indiscriminate, but it was targeted. Nvidia dropped 2.2% and Intel fell over 3% as investors questioned the sustainability of AI infrastructure spending in a cooling labor market. However, high-quality growth showed resilience. Alphabet bucked the trend, gaining 2.5% to briefly overtake Apple as the second most valuable company. This suggests the market is favoring companies with proven cash flows and advertising dominance over speculative growth dependent on corporate capex. Meanwhile, the energy sector rallied as crude oil prices pushed toward $58.50, driven by supply dynamics rather than demand strength. Looking ahead, the market remains in a show-me mode. The modest jobs growth keeps the Federal Reserve on hold for now, shifting the spotlight entirely to inflation. All eyes now turn to next Tuesday's CPI report and the upcoming Supreme Court ruling on tariff authority. These are the binary events that will dictate the next leg of this rotation. The volatility we saw today is likely just the prelude to a pivotal few weeks where policy clarity will determine the winners and losers of the first quarter. Heading into today's open, a major revision to US economic data is casting a shadow over the market. The Bureau of Labour Statistics now estimates that nearly 1 million fewer jobs, 911,000 to be exact, were created in the 12 months through last March than previously reported. You might recall us discussing how leading and lagging indicators can diverge and then get revised into a different story. Today's benchmark cut is exactly that kind of reset. The implications here are huge. This isn't just a simple rounding error, it's a massive preliminary benchmark revision that raises serious questions about the true health of the labour market over the past year. Now, get this, the government's initial monthly jobs number actually relies on a statistical guess called the birth-death model to estimate job creation from new and failed businesses. This huge downward revision suggests that model was far too optimistic and the labour market was significantly weaker than the headlines suggested. This has led to a credibility issue with even the US. Secretary of Labor recently noting that such revisions give the public reason to doubt the integrity of the data. This reinforces a theme we've been tracking, how structural shifts, especially from AI adoption, can confuse high-frequency readings. This revision raises the stakes for policymakers trying to separate cycle from structure. That massive overcount sets the stage for this morning's critical December jobs report, and the forecast is stunning. Economists expect the US economy added just 60,000 jobs last month. To put that in perspective, it takes between 50,000 and 120,000 new jobs every month just to keep up with population growth. The market is bracing for a number that signals the labour market is barely treading water. So what's causing the slowdown? Economists are pointing to a new no hire, no fire reality. According to one senior economist, businesses are very cautious about taking on new workers, caught between the high costs of import tariffs and a massive spending boom on artificial intelligence, hoping for a productivity payoff from AI-driven automation. This lines up perfectly with that dual speed picture we highlighted recently. Minneapolis Fed President Neil Kashkari warned that AI is already causing big companies to slow hiring, even as AI forward firms keep investing. So the thing is, this no hire, no fire environment is a clear sign of extreme corporate risk aversion, and we can see it in the data. The JOLTS survey, which tracks job openings and turnover, shows a low churn rate, meaning fewer people are getting hired and fewer are quitting or being laid off. It's a stalemate. And it tracks with something we noted a few days ago. Beneath the aggregate, there's still hot demand for a narrow band of AI skills while non-AI sectors cool, creating a dual speed market. With Europe, Japan, and Saudi Arabia pouring billions into their own AI ecosystems, that global talent race can keep wages elevated for those roles even as overall churn fades. For Chinese-speaking audiences, it's important to note the tariff issue is a key part of this. The uncertainty around trade policy acts as a brake on hiring, especially for American manufacturing companies that have supply chains linked to China. This means that even if the Fed cuts interest rates, it may not be enough to revive hiring in these blue-collar sectors without a change in trade policy. This puts the Federal Reserve in a tight spot. A weak report could give the Fed cover to keep interest rates right where they are, but a bigger risk is brewing. An economist at Citigroup warns that if the unemployment rate unexpectedly ticks higher to 4.7%, it would confirm downside risks to the labour market have increased and could even open the door to a rate cut. As we've anticipated, cutting preemptively risks, reigniting wage inflation in those AI-constrained niches, and if AI ultimately nudges the neutral rate higher, yields could stay under upward pressure, limiting how much relief the Fed can credibly deliver. This all points to one powerful conclusion heading into the trading day. As one chief economist at Santander US Capital Markets puts it, the Fed can't fix this. He states, the Fed is certainly powerless to counteract the concerns related to AI. And it brings Powell's own, we're going to have to see caution right to the forefront. That productivity paradox is here as companies wait for proof that AI pays off, but that's not the whole picture. The real turning point is that we may be witnessing the beginning of a jobless expansion. This is a wild new economic reality where companies invest heavily in AI, which boosts overall economic output and productivity, but they don't hire more people to do it. I mean, think about it. Productivity goes up, but corporate hiring plans go down. This challenges the very foundation of the Fed's power. Its main tool, interest rates, is designed to manage the demand for labor, but it can't force a company to hire a person when its entire strategy is to automate that job. The ultimate test, as we've said before, is whether multi-factor productivity, MFP, actually accelerates. Industry leaders argue AI augments workers, but if that doesn't show up in MFP, it's more hype than substance. So heading into the open, watch not just the headline jobs number, but the wage growth and productivity data that follow, especially any sign of MFP firming alongside continued premium pay for AI skills. This divergence between productivity and jobs could be the defining economic story of the next few years. We've just been talking about a no hire, no fire environment where corporations are paralyzed by risk. Well, that's certainly not the case in Hollywood because the battle for the film industry just went nuclear. Paramount Skydance has publicly declared that a key part of Netflix's bid for Warner Brothers Discovery is effectively worthless. This is a dramatic escalation in the hostile takeover war for the owner of Harry Potter and the DC Comics universe. This is where the situation takes a more complex turn. We're not just seeing a fight for control over some companies. We're seeing a fight for major assets of US cultural soft power. A successful merger would create a US content behemoth, but this could also provoke protectionist responses like stricter content quotas in Europe or tighter market access in China, which could impact the new company's global growth strategy. This global chess match is the backdrop for all the drama. The core conflict ahead of the bell is this. Paramount is pushing its $108 billion all-cash offer for all of Warner Brothers. To do it, they're attacking Netflix's rival $82 billion deal, which would see Netflix buy the studios and streaming assets while spinning off the cable networks like CNN and Discovery to shareholders. Paramount's big attack this morning centers on one claim that the spin-off is worth less than nothing. They're pointing to the disastrous market debut of a similar company, Versant Media, which has plunged 18% since it started trading. Paramount is telling investors that the Netflix deal could leave them holding a rapidly sinking asset. What really brought this to a head is what this attack represents, a public declaration of a terminal value crisis for traditional television. Paramount is essentially telling the world that the future earnings potential of these legacy cable assets is zero. Their valuation math, based on research from firms like Moffett-Nathanson, assumes a forward EBITDA multiple of just 3.8 times. To put that in simple terms, they're valuing the entire cable division at less than 4 times its expected annual earnings, a clear signal of deep pessimism about the future of linear TV. Heading into the open, watch for this narrative to weigh heavily on any company with significant exposure to traditional cable revenue. But the Warner Brothers board is holding firm, rejecting Paramount's offer as inadequate and highlighting the extraordinary amount of debt required. So what makes that debt so extraordinary? It turns out traditional debt markets, like big banks, are becoming very hesitant to finance these kinds of highly leveraged media deals. This forces bidders to rely on what's called whale financing. In this case, a massive $40 billion personal equity guarantee from a single tech billionaire is backing the bid. This dependence on an individual's fortune, rather than institutional lenders, increases deal volatility and concentrates immense power, which is likely a major reason for the board's caution. Walking away from Netflix would also trigger a massive $2.8 billion termination fee. That fee is critical because it was supposed to be a poison pill to prevent the board from walking away, and now that defense is being put to the ultimate test. This creates a major power struggle. Some of Warner Brothers' own major investors are now publicly pressuring the board to negotiate with Paramount, splitting the company's backers. If these activist shareholders succeed in forcing the board to pay the fee and switch to Paramount's offer, it would set a huge precedent. It would signal that a big, immediate cash premium can override a board's negotiated protections, potentially weakening the power of breakup fees in future M&A deals. Pre-market shares of Warner Brothers Discovery, ticker WBD, and Netflix, ticker NFLX, are slightly down. Paramount, ticker PSKY, is ticking up. So at the open, traders will be watching how this deal risk premium plays out. The reason Warner Brothers stock isn't soaring on a massive all-cash bid is because of significant antitrust risk. The current regulatory environment in both the US and Europe is extremely tough on media concentration. This heightened regulatory barrier means that no matter who wins this bidding war, the final deal faces a long and uncertain path to approval. This uncertainty could keep a lid on the stock price, even with a compelling offer on the table. This all sets up a showdown at the opening bell as traders weigh a massive all-cash bid against a board that's saying no and a rival that won't go down without a fight.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.